I want to get your thoughts on another debate between CEOs and investors that's kind of heating up here. Oil is back to around $50 a barrel, and executives like Harold Hamm, CEO of Continental Resources, are optimistic once again. Here's what Harold Hamm said when he spoke with Alex Steele earlier this month. Take a listen.
I believe that this price below 50 is very short-lived. We're seeing it above 50, and I think it's sustainable above 50. We're seeing inventories come crashing down, coming down faster than they have over the last 2 years.
Jim, this month you announced a short on Continental, along with a handful of other shale producers. Yeah. It's no surprise that drillers are always increasing their debt to fund these projects. What makes this time different? Why now?
Well, I mean, we've been negative on this space for a while, on and off, for basically the last 5 years. And the problem is the structure of the E&P space, the frackers in the U.S. And they are really dependent, they're creatures of the capital markets. Because the wells deplete so quickly, they constantly need to raise money to replace the assets. And this is the crux of the story. This is a great deal for the executives like Mr. Hamm. This is a great deal for the financiers on Wall Street to finance these companies. It's been a really, really crummy deal for the shareholders of these companies. And I don't know where the oil price is, but here's the funny thing. Mr. Hamm doesn't know where the oil price is going to go either. He very famously removed his hedges at Continental when the oil price was $80 to $90 a few years ago, back in 14. So, I mean, he's an oil patch guy, and he doesn't know. So the problem is you have to look at these things based on where the oil prices are now. And I want to stress one thing. A company like Continental and other companies like Chesapeake and others, everybody watches WTI. But Continental's case, you have almost half, about 40% of the company is natural gas. And an awful lot of these companies are tied to natural gas. The natural gas price is right near its lows.
Right.
Yes.
You know, so you have to look at the combined aspect of their energy output. But the crux of the story is that the wells deplete faster than they're telling investors. They're depreciating them on the income statement. So the earnings are overstated.
You mentioned, I think, right in the first block we were talking about, kind of as a casual aside, that financial conditions were tightening, that central banks around the world are in more of a tightening mode, and maybe people aren't paying enough attention to that. Is this the kind of area, because they're, as you say, creatures of the financial market, that could be collateral damage in a central bank tightening cycle?
Well, let me be clear. They're getting ready to tighten.
Okay.
I mean, we and by that I mean reduce their balance sheets.
Right.
So we have a Fed that's about to go into negative, i.e. start selling. And in the case of the ECB and the Bank of Japan, which are the two big providers of liquidity, some observers think they're going to be moving towards zero toward the end of 18. So by the end of 18, we'll be looking at basically no more stimulus in terms of actual bond buying and equity buying by central banks. That's a big change. That number was 120 billion a month, even more. And to go to zero, and while the stock of the global stock and bond markets is about 180 trillion, so these are still relatively small numbers based on the size of the markets, I think they had a disproportionate signaling effect. That is, people always felt they had to put courtesy of the central banks, and that's going away.
For Continental Resources, so you said, look, if these guys don't sort out the situation by the back end of this year, then they're going to struggle to pay interest again. How is the situation, based on what you've said, if they're overinflating their earnings, actually going to improve?
Well, what I really said by that was the so-called EBITDA, which everybody looks at, is something that is overstating things because the depreciation and amortization is real here. So in Continental's case, they hope to have EBITDA of over $2 billion this year, but their capital spending is supposed to be about $1.9 billion. That doesn't leave a lot of extra money.
Wow.
You know, $300 million, $200 million to service their quite considerable debt load. And so this is the inherent problem. It's not that they're going to miss a coupon payment,
no.
but that it underscores the structure of the leveraged frackers, that capital spending here is a real expense. You can't just look at the gross cash flow number, because if you don't invest, your production will plummet.